Disney's going to report quarterly earnings this week, and this is going to be a really critical quarter for the company. As we look to 2024, there's a lot of changes that need to happen at Disney. The company needs to at least stabilize the linear TV business that includes ESPN. We need to see losses. We need to see the streaming business go from losses to potentially a profit by the end of this year. And the parks business, which is coming off just a phenomenal run over the last couple of years, needs to continue to be a cash cow for this company. So I want to go through each of those segments and what investors should be looking for and the trends that I'm looking for as a shareholder from Disney. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with the moneymaker because I think right now you could almost value Disney as a company just based on the experiences business alone. This is such a phenomenal business. This is a chart of Disney's experiences, revenue, and operating income. So revenue is a little bit lighter blue and operating income is a little bit darker blue on the right. You can see that over the past year, almost $9 billion worth of operating income from the experiences business. Now, this includes all of their parks all around the world, their cruise lines, and all kinds of other smaller things that they do. But this is really where Disney is making most of its money now. And I don't think this is a business that's going to slow down anytime soon. People are still looking for more experiences. And the great thing for Disney is that most of these assets are already built. So the biggest cash spend is going to be upfront, actually building that resort. And then as you go forward, a lot of the revenue that they generate is going to be cash flow. So on top of their operating expenses, any increase in revenue is going to flow disproportionately to the bottom line. That's operating leverage that you have in a business like this. That's why results have been so strong recently, is the increase in revenue that they had coming out of the pandemic, where prices have gone up because demand has been really strong, has meant operating income has been really strong as well. Now, management is going to invest another $60 billion into this business over the next decade, about doubling their rate of investment. So that probably means that we're going to get another major resort, add some more cruise lines, expand some of the existing resorts. So I think this is going to continue to be a cash flow machine for Disney. And we just want to see that momentum continue in the calendar fourth quarter of 2023. Given that Disney has a market cap of $178 billion, as I'm recording this, you could argue that the experiences business alone could account for a vast majority of that valuation. But there's a lot more to Disney than that. And the next thing I want to go through is the linear TV business. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, there are a number of ways to look at the linear TV business, but I'm going to break this down into a couple segments because Disney is reporting things a little bit differently than they used to. The first way to look at it is the linear networks, and you can see that revenue was down 9% in the most recent quarter. The good news is operating income was about flat. So I think this is consistently what we're going to see in the linear networks, and this is non-ESPN. So this would include ABC, the Disney Channel, and all those ancillary channels that go along with that. What Disney is going to try to do is slow down the losses in revenue and then cut costs as much as they can, because this is, at the end of the day, probably a business that is not meaningful for the future of Disney. It may start selling off some of these assets, but you want it to just generate cash as much as they possibly can until we get to the future when streaming is going to really dominate the business. If we go down to sports, and this is where ESPN is reported, remember Disney changed the way that they reported in the last few quarters. So now sports and specifically ESPN kind of sits on its own. So revenue in the most recent quarter was actually up 1%. So a lot of demand for ESPN content and also advertising on ESPN. Operating income was actually up 16%. So pretty strong results for ESPN. I think this shows the differentiation and the strength specifically in ESPN at Disney. And so when you combine these two, you combine the traditional linear networks with ESPN. Ideally, you would like revenue to be about flat. I think that's probably asking for a lot. We're probably going to see a decline in revenue. But if operating income stays flat or even increases a little bit long term, that will be a positive for the business. Now, streaming is another story, and there's a few things going on with streaming. One, Disney is now buying all of Hulu. So they're starting to bundle Disney Plus and Hulu together. That should bring in more revenue and more subscribers and make that bundle a little bit stickier. We haven't yet seen ESPN go over the top. So that would be the next step. But direct to consumer, which is where they have their revenue for streaming, was up 12% in the most recent quarter. I think we'll probably see even more increases beyond that just because of those price increases. But the loss was $420 million. And what you want to see is this get closer and closer to break even. I think that will happen probably in the next few quarters. But if there's any surprises there, like there's a surprise operating income in the streaming segment, that would be phenomenal news for Disney long term. The other thing to watch is their streaming subscriber numbers. And the comparison here is that Netflix actually had a record number of new subscribers in the fourth quarter. So does that also translate to Disney? They had a really good calendar third quarter. This is Disney's fiscal fourth quarter, but calendar third quarter up 7%. And this is just in 3 months to 112.6 million in their core markets. This is really where you want to focus for Disney because the Hotstar business is very, very low margin. That's why losing subscribers in Hotstar, not really a big deal for Disney. But you want to see this number increasing. And then you also want to see prices increase. They report that here. In the most recent quarter, the average Disney Plus core subscriber was spending $6.70 on Disney Plus. Hulu is down here at $12.11, and for video on demand, over $90. So you want to see increases, and there should be some price increases starting to hit both here and also for the Hulu market as well. That should help. And along with cost cuts, this is how you get the streaming business closer and closer to break even and hopefully profitability by the end of this fiscal year. So in the experiences business and linear TV, kind of steady as you go is all you're really expecting from Disney. Any sort of increase in operating profit or revenue is going to be icing on the cake as far as I'm concerned long term. But where you want to see growth is in the streaming business. And Netflix is really the example that we need to see Disney keeping up with. In the most recent quarter, Netflix added 13.1 million new subscribers to 260.3 million subscribers on their platform. Now, Disney is not that big, but they're clearly the number 2 player in streaming. So now when you start adding Disney Plus to Hulu, are you able to create some sort of flywheel and get this growth engine going, start to reach close to those Netflix numbers? You also want to hear on the conference call what the future of ESPN is. We know ESPN is going to be going over the top. So basically the whole channel is going to be streaming. And then we'll have sort of a triple play bundle with Disney Plus, Hulu, and ESPN. But when is that happening? What is that going to look like? Are we going to get some sort of partnership like we have heard rumored with the NFL? Is there going to be more NBA or MLB content? There's a lot of things that need to be answered for ESPN. If Disney can turn ESPN into the go-to place for streaming sports, that's going to ultimately be the most valuable position for Disney to be in. That would be an extremely valuable bundle. You have everything from sports fans to kids content, and then that really high quality IP that Disney has potentially in just one bundle. So that's why I like Disney long term, but this quarter we want to see steps in the right direction in all 3 of those businesses. In particular, the streaming numbers, not only the number of subscribers, but also the costs and then the revenue per subscriber. Those are if I had to pick out 3 numbers that are going to be really critical for this report, those would be the 3. What do you think about Disney's upcoming report? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.